In 1995, Howard Marks left TCW Group at 49, walking away from the distressed debt franchise he had built over a decade, without the legal right to take a single client. The firm he started from that point, Oaktree Capital, became the largest distressed debt platform in the world, managing over $200 billion by 2024. The distance between those two facts is the entire story. Howard Marks was 49 when he walked out of TCW in 1995. With him went Bruce Karsh and a handful of the most senior distressed debt specialists in the business. For a decade, this team had built TCW's reputation in the high-yield and distressed credit markets, managing billions in assets and drawing the attention of the largest institutional investors. The group's approach was methodical, buying troubled debt at deep discounts, restructuring companies, and focusing on risk control when others chased yield. By the mid-1990s, their franchise inside TCW was both lucrative and highly visible, but the partnership fractured over who would control the future of that franchise. Marks and his colleagues pressed for autonomy, proposing a spin-off that would let them run the business independently while sharing fees with TCW. The firm's leadership refused, unwilling to let a core business walk out the door. The disagreement was not about poor results or personal animosity. It was a boardroom decision about power, revenue, and the direction of the firm. In the end, TCW terminated Marks, Karsh, and 3 other senior officers. The separation agreement barred them from taking any clients or assets. They left behind the entire client list, the brand, and the platform they had built. The loss was absolute. No client relationships transferred. No assets moved with them. The team exited at the top of their game, with a track record but without a business. For Marks, the setback was professional, not personal. A clean break enforced by legal constraint. The only path forward was to start again, without the safety net or reputation of a large institution behind them. Howard Marks's reputation in credit investing was not built overnight. Born in Queens in 1946, he grew up in a working-class neighborhood and earned a finance degree from the Wharton School at the University of Pennsylvania, graduating cum laude. He then completed an MBA at Chicago Booth, focusing on accounting and earning the George Hay Brown Prize for academic distinction. This formal training in both finance and accounting would later shape his approach to risk and valuation. In 1969, Marks began his career at Citicorp Investment Management. He started as an equity research analyst, but within a decade, he was promoted to director of research and soon after became vice president and senior portfolio manager. At Citicorp, he was given responsibility for convertible securities and high-yield debt portfolios, areas then considered niche, but soon to become central to modern credit markets. The environment at Citicorp emphasized credit fundamentals and disciplined risk assessment, laying the groundwork for ideas that would later surface in his investment memos. During this period, he also worked alongside leading figures in the high-yield bond market and absorbed the principle that paying a low price for a high-quality claim could be the key to outsized returns. By 1985, Marks moved to TCW Group in Los Angeles. There, he led the firm's high-yield, convertible, and eventually distressed debt groups. In 1988, he and Bruce Karsh helped organize one of the first institutional distressed debt funds, giving pension funds and endowments access to a strategy that had previously been the domain of a few Wall Street trading desks. Over the next decade, the team built a disciplined, process-driven approach to buying troubled debt, focusing on downside protection and the careful restructuring of distressed companies. The credibility that followed Marks into his next chapter was the product of this long apprenticeship, a track record of steady, analytical work in credit markets, not sudden reinvention. Oaktree Capital Management was formally established in Los Angeles in April 1995. The founding partners, Howard Marks, Bruce Karsh, Sheldon Stone, Larry Keel, and Richard Masson sat together not as a group looking to reclaim lost ground, but as architects intent on building something new. Each brought a distinct area of expertise: Marks and Karsh in distressed debt, Stone in high-yield bonds, Keel in leveraged finance, and Masson in real estate credit. Their collaboration was deliberate, shaped by the lessons of their forced exit from TCW. The legal structure of the firm gave exclusive voting rights on major decisions to the 5 founders, ensuring that strategic direction would remain in their hands regardless of future changes in ownership or public listing. Unlike most asset managers spun out of established institutions, Oaktree did not inherit a ready-made client base or a portfolio of assets. The separation agreement with TCW barred the team from soliciting former clients, so the first months were spent reaching out to long-standing contacts, pension funds, and endowments, many of whom had known the partners for years but could not follow them automatically. Early fundraising relied on personal trust and the credibility of past results, not on a brand or distribution network. The initial capital was modest by industry standards, reportedly around $100 million for the first fund, with total commitments reaching approximately $1.5 billion within 3 months. Growth was cautious and measured, reflecting both necessity and philosophy. The founders controlled every aspect of the launch, from investment mandates to risk oversight, setting in place the governance that would define Oaktree's culture for decades to come. The firm began not as a reaction to loss, but as a conscious exercise in independence and discipline. Distressed debt investing starts with a simple premise: buy the debt of companies in financial trouble at a price far below what it might ultimately be worth. Oaktree's approach is to purchase these bonds or loans when most others want out, often at a deep discount to the amount owed. The return comes if the company manages to restructure, repay, or sell assets, allowing investors to recover more than they paid. This is not a strategy built on hope or quick turnarounds. Each investment requires a careful estimate of what can actually be recovered, with a sharp eye on what could go wrong. Marx often sums up the philosophy in one line: "It is not what you buy, it is what you pay." Oaktree applies this discipline beyond just distressed debt. The firm also invests in high-yield bonds, convertible securities, and real estate-related credit. Across each area, the focus remains on price, risk, and patience. The team avoids chasing hot sectors or relying on optimistic forecasts. Instead, they look for situations where the downside is limited by the low purchase price and the upside comes from disciplined execution. Marx has written that risk is what remains after you think you have accounted for everything, a reminder that unseen dangers are always present. The edge, as practiced by Oaktree, lies in waiting for the right price and never forgetting that the biggest risk is the one you miss. This approach favors caution over speed and values the ability to withstand uncertainty rather than the promise of fast gains. Market stress has always tested Oaktree's philosophy. During the aftermath of the dot-com bust in the early 2000s, the firm found a wide field of distressed debt trading at deep discounts. Where many investors hesitated, Oaktree committed capital to defaulted telecom bonds and battered retail loans, often paying just 30 to 45 cents on the dollar. The approach was measured. No rush to deploy, no attempt to catch every bounce. Internal discussions at the time, later referenced in Oaktree's own timeline, show a clear mandate: buy when others are fearful, but only at prices that leave room for error. The 2001 downturn was not an isolated event. In 2008, as the global financial system seized up, Oaktree raised what was then a record-sized distressed fund, ultimately deploying $13 billion across mortgage-backed securities, corporate loans, and sovereign debt. Many institutions became forced sellers, scrambling to raise cash. Oaktree, with patient capital and dry powder, acted as a steady buyer, acquiring assets at 20 to 30% of face value. The firm's willingness to be active in periods of panic, when liquidity disappears and prices disconnect from underlying value, proved the model was designed for dislocation, not for calm markets. Marx described the environment as a bargain bonanza, but the real distinction was a refusal to let market fear dictate the pace of decision-making. This counter-cyclical discipline became the clearest expression of Oaktree's founding principles. Oaktree's evolution from a specialist credit shop to a global institution became unmistakable through a series of public milestones. In April 2012, the firm listed its shares on the New York Stock Exchange, offering investors a rare window into the mechanics of distressed debt investing at scale. The initial public offering priced at $43 per share, raising several $100 million and placing Oaktree among the handful of alternative asset managers to enter public markets. 7 years later, Brookfield Asset Management acquired a controlling interest, purchasing approximately 62% of Oaktree for about $4.7 billion. Howard Marks and Bruce Karsh remained as co-chairmen, retaining influence over investment policy and firm culture even as majority ownership changed hands. By 2024, Oaktree managed more than $200 billion, with its distressed credit platform recognized as the largest of its kind. Despite the shift to public ownership and outside partnership, the firm's decision-making structure continued to reflect the founder-driven discipline established in the mid-1990s, underscoring a form of durability not often seen in financial markets. Howard Marks began writing memos to clients in 1990, years before Oaktree was founded. These early letters, circulated first among a small group at TCW, explained the logic behind each decision, the risks others might overlook, and the patterns he saw repeating through market cycles. By the early 2000s, the memos were posted publicly on Oaktree's website, reaching far beyond the firm's investors. The writing is spare, focused on cycles and risk control, and what Marx calls second-level thinking, the discipline to look past the obvious and question what others take for granted. Over time, the memos became a reference point for professionals across finance. Warren Buffett has said, "When I see memos from Howard Marks in my mail, they are the first thing I open and read." The collected essays were distilled in 2 books, The Most Important Thing in 2011 and Mastering the Market Cycle in 2018. Through these, Marx's private judgment became a public resource. The authority he built did not rely on bold predictions or self-promotion, but on a steady record of restraint, clarity, and a willingness to say what others would not. Discipline and patience, not bravado, built the largest distressed debt platform, managing over $200 billion by 2024, according to Bloomberg. In markets shaped by cycles and memory, restraint remains rare. The lesson endures. Authority in finance is earned quietly over decades, through judgment when pressure is highest.